All right, everyone, welcome to Client Support Group for end of September 2023. You are with Cody Smith and Nathan Bennett and a whole bunch of our friends as we talk through some stuff going on in the market. So looking forward to talking with you. Thanks for your time today. Here's our disclosure. We can't even talk to you if we don't put this slide up. You guys are probably used to this by now, but we'll start with that one. Got the preliminaries out of the way, and we can talk a little bit about the markets in the last year. We are coming up on the 1-year anniversary of the market bottom in October of 2022. We thought it was a good time to take stock of what was going on in the world and give everybody a heads up, because I think maybe the perceptions versus the reality are a little bit off. So we'll kind of start here. I may ask Cody for a little help on some of the managers we use, etc. Year to date 2023, where are we? It's been an interesting year in that we have certain indices doing pretty well and others that maybe haven't come along. And I think the narrative certainly in the media is that, oh, the S&P is fully rebounded and things are great. So this is as of a couple days ago, as of September 26th, we are looking at the S&P 500. Those are the large cap stocks in the United States. The Russell 2000, those are the small cap stocks in the United States. The Bloomberg aggregate, that's a bond index, as well as the EFA, the EAFE, that's the international index. So just to give you a sense of what we're looking at here, the purple line is the S&P 500. It has done the best year to date. It was up 11.3%. Might be off just a touch from between those 2 days and now. The next best performer was the international markets. They're up 5% year to date. Small caps, believe it or not, are only up 1.3%. And here we are at bonds pulling in at the back of the field, actually almost a negative 1% year to date. I think people's perception is markets have been great this year. And maybe you're looking at your statements going, why aren't I doing better? Because we thought we were recovering. So I thought this might provide some context for you. Let me compare that to the market peaks, because this is probably what people judge. When our experience is that we meet with clients and talk about a review, you remember that number at the highest point ever. That's human nature. And we've had a couple clients this year say, I remember when my portfolio was worth, pick the number. And am I really down, X% from that? And it was a lot worse at one point, but they're still not there. So I thought this might be helpful from the market peaks at the end of 2021 to see that the S&P 500, despite the recovery, is still down 10% from its high. International markets similarly down 12. The sort of peach colored line there, that small caps are actually down 20. They really haven't recovered at all. And interestingly, and probably unique to this downturn, is that royal blue line where bonds are down 13.8%. Whatever happened to diversification helping and bonds being a ballast in the portfolio when equities got hurt, in this case, they've underperformed the S&P 500 through a bear market. And many of you know, and we've been talking about it both in articles and in our individual conversations, it's because the Fed went on the rampage to slow down our economy and raised interest rates big time. When interest rates go up, bonds get hurt. And so long-term bonds, especially, just for context, if everybody's sort of got that in their mind, this is what I remember things being like at the end of 2021. Where are we now? We're not quite back yet. It's definitely better than the bottom, where things were down 25, 30% at times, but it is not all the way back to break even. And then I'll just go 1 year later, and then this will help. Cody and I can talk a little bit about some of the managers we use that have areas that have done well and some that maybe not so much. But if we're going from the bottom, now all of a sudden you see positive returns. But since that bottom, the international markets have actually done the best, almost up 20%. The S&P 500 is up about 12. The Bloomberg aggregate is positive, although not terribly far. And the Russell 2000 is the laggard there at up 2%. Interesting to see that switch. We went value, sort of really outperformed in 22, but growth is back in 23. And we're actually going to talk a little bit about that right now. Phenomenon that we've been paying a fair amount of attention to. We went through this with a client the other day. They happen to have a pretty significant S&P 500 chunk in their 401k plan at work. And they're like, why is that performing better than my more diversified stuff? And when we dug into the S&P a little bit for them to really help them understand what's happening, we have maybe the most unbalanced contribution to the S&P 500 that I can remember in my career. 7 companies now, the big mega caps, make up almost 30% of the S&P 500. In fact, for a moment, they were over 31%. Their weighted average rate of return this year is 67%. So those companies are like Apple, Microsoft, Amazon, Nvidia, Alphabet, and Tesla. They have just, like, Tesla's up almost 100% year to date. Nvidia is up 188% or something like that year to date. Apple not as much, Microsoft not as much. But you take those weightings where basically almost a third of the index has this massive growth, and you're going to get a decent number on the S&P 500. Even though over half of the stocks in the S&P 500 as of a couple of days ago were actually in negative territory for the year. So when you see a market return year to date on the S&P 500 that's in the double digits, I think one would think, and normally you would think, well, it's a pretty good year. And I think what we have is a bifurcated market where a few tech companies came back off of their lows, and some of them got beat up. Things like Tesla got beat up pretty good in 2022. But it might be skewing the averages a little bit, kind of giving people a different sense of what's going on. When we break that apart and we start thinking about that as advisors, we're like, we're not sure we love 7 companies driving the entire S&P 500 and our returns. In fact, it's getting harder and harder to find managers where they don't just own those big 7 companies. So we're trying to do a good job staying diversified, even though it might mean that you're not outperforming that index if you don't have such a huge weighting to those assets. And to illustrate that point, I apologize if this is a little bit of a busy slide. We have used this before, but it's been updated, which I think is kind of interesting. This is put out by the good folks at BlackRock, and it talks about how the concept of being diversified works, but often it never feels good. And so if I were to walk you through this, in that first tranche here, 2000, 2002, you might remember the technology crash, sometimes referred to as the tech wreck, where the S&P 500 fell 40%. I remember it well because that's where I started my career, preaching diversified portfolios to people, and it looked like you did a really great job when you only lost 15% compared to tech getting smashed. But nobody was really happy. The emotion of that time was I lost money. 03 to 07, there's a rebound. Fine, diversification worked great. 2008, mega crash, right? The housing crisis. S&P falls 37. Diversified portfolios fall 26. Nobody called us and said, thank you so much for losing less than what the market went down. Everybody was very fearful. On the recovery for the next 10 years, the market roared forward 350%, but the diversified portfolio lagged behind. It only went up 200%. And people were like, why am I not keeping up with the market? You get the idea. 2021, that huge rise off of the COVID fall, your S&P is up 119% and diversified portfolio is only 66. And then in 22, just recently, if you're just feeling this, S&P 500 down 18% and a diversified portfolio was down 15. None of those did you really feel like you were crushing it. But at the end of the day here, when you compare those two things over that period of time, which coincidentally kind of looks like a good chunk of someone's retirement, the diversified approach actually came out ahead. And so it works even when it feels like it's losing every time. And we're not here to say that being diversified is actually going to outperform, because we can't say that. But we can say over various market cycles like we've seen, it often is that your emotion tells you that diversification is not working. And we spend a lot of time in our office talking about diversification and allocations and where we should put money to work. But you can't forget that at the end of the day, being able to stay diversified and not have some of those downturns be quite as severe has really been meaningful to people's long-term performance. So we hope, despite that being a busy slide, I hope that that's a helpful illustration and how the emotion of investing doesn't quite match up with the reality of it at times. One of the great things about joining Raymond James, they got a very cool research department, and they put out an article the other day that I found kind of interesting, and I thought we should share it with you. We do a ton of dollar cost averaging around here. And so, Cody, if I could ask you, would you just explain to everybody what dollar cost averaging is?
Sure. Dollar cost averaging is a basic strategy that tries to take the emotion out of investing, where you're essentially trying to avoid market timing. So at any given point, if you have new dollars that need to be put to work in the market, you may be looking at the news, or you may be looking at what's going on in the world and afraid to go do that. Dollar cost averaging is where you set periodic payments over a scheduled amount of time to help mitigate volatility that potentially could happen within that period. Essentially a way of trying to avoid market timing where it could hurt you.
You bet. And so Raymond James folks, we've known this forever. Cody and I always joke, oh man, if we dollar cost average into this, the market for sure is going to roll forward and we're going to feel like we missed it for clients. And if we dump it all in the first day, for sure it's going to go down 10% next week and we'll feel like we hurt clients. So we always sort of internally have a running dialogue around, dollar cost average or not. Well, the good folks at Raymond James did some research on this and I actually found it really interesting. So they looked at the 10-year rate of return for 4 different strategies over 40 years. And so they're measuring from 1983 till 2023. And they're only using the market high points where there was still 10 years of room behind it to see how things did. So thinking 1987, 2000, 2008 has not been in there yet, or 2008 is in there yet, but the COVID downturn, of course, wouldn't be because we don't have enough time behind that. So they've got these high points during the market. And they said, we're going to compare if we put in all our money on Monday or on the beginning of the month in a lump sum every single month for those 40 years without regards to where the market is. That was one analysis. Then they're going to do one where they actually picked the worst possible time. So every time the market was at a peak, think 2007, think 1987 before the crash, that they put in all the money that day. So that would have been the worst possible time. Then they did a dollar cost averaging strategy. I think they used over 7 months was their strategy, monthly dollar cost averaging over 7 months at market peaks. And then of course they said, well, what if you just left it in cash? And to my knowledge, I'd never seen this research done anymore. So I thought it was really terrific and helpful to see some data. And these were the answers. So if you just blindly put it to work every single month between what, would take a chunk of money and you just put it to work at the beginning of the month and it didn't matter whether it was a high point or a low point. They analyzed every single one of those months for that 40-year period of time, and the average was 11.7%. And we've seen a lot of stats like that, Cody and I have over the years, where you're like, just put it in, it always works out better. But nobody ever actually showed us what if you invested the lump sum at the market peak? And that's what everybody's afraid of, right? Put the money to work at the peak, we're just going to lose money. Well, you still earned 8.3%. So I would say it's a heck of a lot better than leaving investments in cash over on the right-hand side of the screen. But it's markedly different than the average for the long run. So I can understand people's fears. What was really interesting was this third column here. So if you dollar cost averaged into the market at those market peaks, your rate of return was 10.4% over those periods of time. I look at that and say 10.4 is close enough to 11.7 to be good enough for me. And when we talk about the following phenomenon, which Cody and I deal with all the time, it becomes the thing that's a go-to for me. And so Cody, I'm gonna let you talk about this and maybe some of our meetings together where, how do people view loss compared to gain? And then we do it in the context of this dollar cost averaging thing.
Yeah, I mean, the napkin kind of summarizes it right there is people feel pain or their loss aversion almost 3 times more than they do from getting growth or market gain. And it happens all the time. I'd say it's the most common theme in our client review meetings where we're talking to folks and looking at, especially over time, if you have bigger dollars and you watch being an investor for a decade and you see those dollars go down, if you see it go down by a lot, you feel it a lot more than if you had earned like just 7% for the year, if it's the same math on the upside. So it's interesting how humans behave, but it's definitely a common thing.
And I looked at that because we do see that, right? If we go back to these results, I would love for everybody to average 11.7. That would be great. Let's just blindly put it in and not worry about it. But I think human nature says that you put $1 million in and see it down to 900,000 2 weeks later because some market slide, really occurred that week. That's a tough emotional hit. And I'm much more interested in winning the war of your financial independence than I am you feeling great about that first week. And so if dollar cost averaging is the thing that allowed someone to get in the market instead of staying over here in cash, where the long-term return's been 3%, which doesn't even beat inflation, I'll take the win. So it's some validation for us that the dollar cost averaging works. And it's a good way and a good reminder because we've moved to a spot right now where interest rates have risen dramatically and you can get paid 5% for sitting in a money market right now. That's probably a fleeting thing, probably won't last forever. But it's tough for investors to get off of that and feel like, you know what, I really should put money to work. And equities will win over time, but you do have volatility. And we've had very good lesson of that in the last year. I just found this to be really helpful as we manage behavior as clients are reticent to put that money into the market because they're afraid of loss. Boy, maybe it's not the same as just catching everyone perfectly by putting it all in the first day. But if you're basically 2% better on average by dollar cost averaging at market peaks, we never know when those market peaks are. And so I think dollar cost averaging is a good strategy. And to illustrate that, Cody, maybe you could walk everybody through one of our favorite slides here on just how hard it is to predict market peaks.
Sure, yeah. So this is a graph everybody's probably seen at some point talking with us, but it's one of our favorites. And you talk about being afraid or leaving it in cash. This graph highlights missing the best days in the market. So if you look at the far left here, this shows an investment of $10,000 in the S&P 500 just over the past 20 years. And so if you had put $10,000 to work 20 years ago and left it alone and been fully invested through all the bad times and good times, you end up with $65,000 for round numbers. That's about a 9.8, almost 10% rate of return, if my math's okay on that, over time. And then if you jump to the right column, just the second to the right of that, if you had missed just 10 of the best days, so 10 days within a 20-year time period, you actually have your investment return right there. So it's probably like a 5% base investment return. Now, the thing is all the best days are usually in those bad times. And I think there's part of this graph that's missing here where it shows like all those moments that are the best days usually are a rebound off something that's been really bad. So it's part of being an investor is you're signing up for a long term. You're an investor. You're not a trader or a market timer by any means. And that's really what this graph's trying to show is that timing the market is really impossible because those best days are typically in moments of volatility and right around the worst days, if you will, too. You keep going down the right of this graph. If you follow to the right, you'll see that if you miss just 10 more of the worst days, you only have a $17,000 investment. Your money didn't even double over that 20-year time period, and then so on and so forth. Missing 60 of the best days on the far right-hand side, 3 months, you actually lose money at that point in time. You actually lose money at 40 of the best days. So just hammering the point home of being fearful to invest at market peaks. So there's a lot of bad news out there. It's impossible to time the market and that you have to be a participant for the long run to reap those rewards and have some growth.
And it's just too hard. It's just too hard to know when those are going to be. Like this thing says here, 2020, second best day happened immediately after the second worst day. And you could argue if you missed both of those, you would have missed the down day. So it didn't matter. The problem is there's just too many of those to know. And times can be volatile. So if you stick with it, we're talking about rates of return that make sense. And if we're back here looking at if we could take some of that worry out of somebody's heart by walking their money into the market over time, man, I sure like that return better than leaving it in cash because adjusted for inflation over time, that's not going to get it done for people. So hopefully you find that helpful. A little bit of market commentary and some research that we hadn't seen before. This is not a fun slide to end on, but it's one we need to talk about right now. Because it is approaching tax week. April 15 is now October 15 for Californians this year. Almost every county in the state subject to the extension from the federal government, and then the state followed suit that you didn't have to file your tax return, pay your taxes, or even file any quarterly estimated taxes until October. So we have a whole bunch of clients that owe a whole bunch of money in the next couple of weeks. So we put this out there just as a gentle reminder. If that's you, please talk to your CPA. They are getting buried right now, and they're barely able to keep up as people have procrastinated to the last moment. If you need money for taxes, many of you, we know the number already. We're already prepared for it, and we're ready to send it because we've been earning interest on that money for 9 months waiting for this day. But there's always a few surprises. There's always someone that didn't realize they were going to owe a bit of tax. Please let us know as soon as you can. Even if we have your bank all connected up to your investment account, if money's in the money market, it still takes a day or two to get there. So we want to make sure that everybody sees that coming, gets their information, and gets their taxes paid out on time. It's going to feel like a really quick turnaround because you'll have those of you who are self-employed, you've got all your quarterly estimates for this year, plus your taxes that were still due for 22. And then right away, again, you'll be looking at January estimates and April payments in 23. So it was really nice to get a tax holiday. For some of you that owe a bunch of money, we've been able to earn a fair amount of interest while that money sat there, but now it's pay the piper time. And so we're trying to make sure that we're in front of it and that everybody's ready for it. So heads up and maybe send that Starbucks card to your CPA because they're really burning the candle at both ends this week. Thank you guys so much for attending. I'm actually going to stop the recording and stop sharing, and then we can do some Q&A.